Hi, I'm Lindsay Biscaya. Welcome to Market Call. Mike Philbrick is on the show today. He is CEO at Resolve Asset Management, and he'll be taking your questions on exchange-traded funds. So you can call us toll-free 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. Okay, we're going to be joined now by Mike Philbrick of Resolve Asset Management. Hi, Mike. Great to have you. Thanks for taking the time.
Hi, Lindsay. Pleasure to be here.
Okay, so let's start off with some remarks we heard from Jerome Powell this week, talking about how the markets are highly valued. And we saw a reaction to those comments pretty swiftly. Do you think you're saying that's a bit extreme, maybe, for what we're seeing right now?
Yeah, I hearken back to irrational exuberance from Alan Greenspan in 1996 of the internet bubble. And when you think through that, it's interesting if you look back and say, well, how have Fed chair people fared when they've talked about some sort of overvaluation in markets? And it turns out when you look at that, then you look at Powell and Greenspan and Yellen, in fact, markets have been much higher on 3, 6, 9, and 12-month basis. In fact, there's not one period where you have poor returns. So it's interesting that their observations, they're not good timing indicators. That's not to say this time couldn't be different, but it's interesting. And if we hearken back to the internet bubble, where Greenspan made the comments in 1996, the bubble didn't occur until 4 years later.
So what do you think the difference is this time around? Like, what's kind of driving the difference here? I know you talk a lot about AI.
Yeah, well, there's a few things. If we look at it from the perspective of the earnings cycle, and we think back to 2000 and think of the darling stock that was Cisco, and we compare that today to the darling stock that is NVIDIA. Now, NVIDIA has grown an awful lot, and it's, call it expensive, but Cisco is trading at 120 times forward earnings, where, NVIDIA is trading at, something like 25 times forward earnings. That's a pretty significant difference. And then if you look technically at the chart and say, well, how extended are we above something like the 200-day moving average? Because that will give you an indication of how bubblicious or how extreme the market move has been in the recent history. And if we look back at NASDAQ at the peak in March 2000, the NASDAQ was 54% above its 200-day moving average. Now, if we look at the NASDAQ today, it's 14% above its moving average. And I'll correct myself, NVIDIA is about 35 times forward earnings. So your darling stock was 4 times more expensive, and it was 4 times, or the market was 4 times further away from its moving average, the 200-day moving average, which is quite well studied. So those things are occurring, and AI and the AI adoption curve has been followed by earnings. And so the story is, this is an earnings story. The growth is actually there. And so I wonder if investors are going to risk missing out by sitting on the sidelines when they should be actually participating.
Okay, we're going to have to wait and see there. We're going to take a quick break. We'll be back with Mike Philbrick of Resolve Asset Management, taking your questions on exchange-traded funds. That's coming up right after this. Welcome back. We're going to start off with an email question from Roy. This one coming in, reading, I'm wondering, what is the outlook for iShares Silver Bullion ETF for short, mid, and long term? Mike, what do you think?
Well, this was actually a top pick we covered on my last show. And so, yes, so what we have to remember with silver is it's volatile. So that's the first thing. And it can swing a little bit, but at the same time, so short term can be volatile, and it's had quite an upswing. So it moves around the US dollar strength, as well as the price of silver and all that sort of stuff, which are related to US dollar. But again, midterm, we've got a very supportive backdrop for silver. This is a precious metal that benefits from industrial demand, as well as being a sort of preservation of asset precious metal. So it's used in solar, it's used in electronics, it's going to be used in this big AI build out. So if you believe in AI, then you've got to sort of believe in all of the things that build AI. AI isn't built in the cloud, it's built on the ground in data centers. And then it's powered by energy coming from solar, coming from nuclear, there's a grid build out. So all of that is very bullish for the industrial demand side of silver. And long term, there's a potential structural shortfall if this electrification keeps ramping, which we think it will. So I think in the short term, be prepared for some volatility, add on dips. But in the long term and medium term, I would be very bullish silver and silver stocks. And we're going to talk about that in the top picks today.
Yeah, we're going to talk about that a little later. Okay, we're going to move on now to a caller, Terry, calling in from Edmonton. Hi, Terry. What's your question?
Good day. Yeah, I was thinking of going all in on ZWU in my RRSP. What do you think of this strategy, and what are my downside risks? Thank you very much, sir. Okay. Bye now.
Great question. ZWU ETF, what do you think?
Yeah, so first of all, the ZWU ETF is the BMO covered call utilities ETF. And so, going all in on any single sector seems to me a bit extreme because it doesn't hedge you from a number of different macroeconomic situations that can occur. If we get into an inflationary situation where inflation starts ramping up more rapidly than expectations, things like utilities behave more like long bonds, meaning they kind of struggle. So that's the vulnerability to just going all in on this one sector. Having said that, the ETF itself, is based on utilities. So these are kind of safer assets. They respond more slowly to the business cycle. You know that people are going to be powering their houses, cooling their homes, heating their homes in the wintertime, keeping their lights on. So there's a definite tilt to the defensive sector here. And then they sell calls on top of that to enhance the income. One of the challenges with selling calls on utility stocks is because the volatility is quite low on these stocks, the premium that you receive from that call writing activity is lower. And so you're looking at just a lower returning area. It is a more conservative area of the market, and it's a defensive tilt. Those things are all good. There are some vulnerabilities to consider as well. I think I wouldn't go all in on any one sector. But as an ETF in and of itself, if you're looking for the utility sector, you're looking to actually cover right on those, then it's a fine choice, yes.
You mentioned if inflation ramps up more than expected. Just for anyone who's kind of listening in thinking, I know it's probable, but do you think that's likely to happen for anyone who's kind of looking to invest in ETFs?
Well, yeah, part of diversification is recognizing that you don't always know the future. And so you want different things in your portfolio that are going to respond differently to these economic factors. So first thing to solve that problem is a bit of diversification. The next thing is to say, I think that, yeah, we're going to run a little hotter. We're going to have a little bit more inflation, and we're going to have a little bit more growth. But then at some point in the future, in the next couple of years, that is going to meet the deflationary force of AI. And so I think yields could end up lower in the long term as well. So it really is a question of, I don't think we have one pervasive trend in that, like we did from 1982 to 2022, where we had 40 years of persistent falling interest rates. We're in more of an environment where we're going to have interest rate and inflation volatility, and it's going to be sort of around some average. The average is probably a little bit higher than people expect, but I don't know that the trend is going to be higher all the time or lower all the time.
Okay, got it. We're going to move on now to Jay, who's calling in from Nipissing with a question. Hi, Jay.
Hi, Mike. It's great to hear you on the BNN again. I just have a question about your ETF, RGPM, and how you guys are positioned towards gold currently and what you see happening in the future as well.
Okay, thank you. Mike?
Well, thank you. Yeah, we've got positions in gold and silver, platinum, palladium, and they do change regularly. So we are looking across the precious metals area and are both long and short, but generally more long in that area. I think scarce assets are something that most portfolios are really kind of underexposed to in a moment of time where we do have this higher level of inflation and we have the sort of monetary debasement going on. So we are, printing a lot of money, monetizing debt. That's been at the rate of probably 8% a year over the last few years. And when that happens, you want something in your portfolio that's not printable, that's scarce. And scarce assets are things like gold, and to some degree silver, and to some degree Bitcoin, and platinum and palladium, because they cannot be reproduced easily. If we need more oil and oil prices skyrocket, more wells will be drilled and more oil will be produced. If we need more copper, more mines dug and more copper produced. The thing with gold is, as a function of the whole stock of gold, the amount of gold that can be produced, even at all out rates, is only about 2% of the overall supply. So it really cannot be reproduced easily. That's a scarce asset. And a scarce asset serves a different role in portfolios as it performs differently. It responds to macroeconomic factors like monetary policy. In fact, it responds to geopolitical situations in the world. And so we have sovereign nations around the world also stockpiling gold as they look for alternatives to US treasuries for their reserve assets. So there's quite a number of things that are quite bullish, those scarce assets. And I think generally speaking, portfolios are not long enough or don't have enough allocation of those. So I want to make sure I have some allocation of those. We're a little bit more active in the allocations on those types of assets, but diversifying the portfolio, they certainly do.
Okay, Mike, thanks for that. We're going to take a quick break, but we will be back with Mike Philbrick of Resolve Asset Management, taking your questions on exchange-traded funds right after this. Stay with us. Welcome back. We are going to go straight to the phone lines. Ghulam is calling in from Toronto with a question. Hi there. What's your question?
Hi, my question is on ZWB. A previous caller already talked about ZWU, so I'm happy with that one. ZWB, would it be the right time to get in at this price? I'd appreciate your opinion. Thank you.
Okay, thank you. What do you think, Mike?
Yeah, so ZWB is, again, it's the BMO covered call writing Canadian banks ETF. And, I think we want to make sure we understand what we're getting when we're writing calls on various indices. So ZWB, if we look at that, and if we were to compare that to, an equal weight, just an equal weight unwritten portfolio, what you'd find is the total return for the covered writing in the market that we've been in is lower. And so when you're covered writing and getting some income, you're giving up a little bit of the upside. So covered calls are, you have a stock and you say, okay, I'm going to sell a call and the stock's at $10 and I sell the call at $11 and that gives me 50 cents. But now if the stock trades above that $11 price, I'm no longer holding that stock. I've sold the upside to some crazy speculator, if we will. And so when you're in a market that's really trending and quite bullish, like banks have been, you're giving up a lot of that upside. You're giving up more of that upside than you're receiving in premium. Now, that's not good or bad. It's just a fact of the matter when you're investing in these types of ETFs. So if you're an income investor, then yes, the bank ETF, ZWB with the covered written, that's going to give you a little bit more income, but you're going to give a little bit up the upside. And it does hedge on the downside a little bit to that premium you get, but not a lot. So if you have a large drawdown, you're going to take most of that on. So it just depends. If you're an investor that's a little bit more income focused, then put some covered rights in. If you're a little bit more growth focused, then buy an equal weight bank ETF, and then you'll get the growth and you're not selling the calls. And remember, you can always combine the two. So you could say, I'm going to have half in each, or I'm going to have 3/4 in one and 1/4 in another, so that you're keeping some of the upside as you go along.
Okay, we're going to move on now. Charlie is calling in from Montreal with a question for you, Mike. Charlie, what's your question?
Hi, thanks for taking my call. I'm a new investor to the market, and I have some GICs that came to term. So I'm wondering, is it a good strategy to simply buy ETFs tracking the indices, such as VFV for the S&P 500, and obviously I would track the TSX. But I'm wondering, is this a good strategy or prudent? Thank you.
Okay, thanks for your question. Mike, what do you think?
Yes. So I think that just generally speaking, and I'm not speaking to you specifically about about your specific needs, but if you're thinking, I have some GICs, so that's fine. Just remember that you have not had any volatility with the GICs. You've had a fixed set rate of return. And so if this is your first foray into the market, just make sure that you pace yourself and you get used to the fact that you're going to have volatility now from a day-to-day basis. On a GIC, you had a rate of return. You were going to get that rate of return, the interest accrued, and it only went up over the time you've owned it. When you move into the ETF marketplace, now you're looking at combining securities that are priced on a daily basis. So they're going to move up and down. So I want to make sure that you don't get scared out of a position in the portfolio, because even if we go back to the tariff tantrum we had earlier this year, something like the VFV, which by the way is an S&P 500 ETF, but if we have that up, yeah, you can see the decline there. There's about a 20% decline that occurred, and that's in the 500 largest stocks in the United States of America. So those are big blue chip stocks, and they go through these price volatility moments. So yes, moving into ETFs makes sense, but now let's talk about balance. So the VFV, by the way, Vanguard's S&P 500 index ETF in Canada, 9 basis point fee, very cheap, very good access to the US market. But I'd urge you to consider broadening your diversification. You're going to want equities, but yes, let's have some global equities. Let's have some Canadian equities. Let's have some US equities. Let's also have some bonds. And let's also have some gold and maybe a smidge of Bitcoin and those scarce assets in the portfolio to buoy the portfolio in times where we have inflationary shocks. And so one of the past picks we talked about was that we're going to review is an all-in-one equity portfolio from Fidelity. And there are several portfolios like this where you can get everything all in one. So you get not only Canadian equities, but global equities, US equities, you get your bonds. They often don't have necessarily precious metals, and you might have to do that on your own. But something like that. Don't get narrowly focused on just the US or just Canada. Think globally and also put some bonds in there to absorb the shocks that come with growth investing.
Okay, some good advice. We're going to take one more call before we go to break here. Glenn is calling in from Etobicoke with a question. Hi, Glenn.
Hi. I would like to know about HHL, and is this a good healthcare ETF? It has a really good yield on it, and I don't see that there's much downside left in it.
Okay. Thanks, Glenn. Mike, what do you think about HHL?
Yeah, so the HHL is the Harvest Healthcare Leaders Income ETF. And this is an ETF where you're looking at the largest healthcare companies in the world. And, it's holding, about 20 to 23 of the very large global healthcare names in an equal weight basis. And, you've got pharmaceuticals at about 35%, you've got healthcare equipment about 25%, biotech at 14%, and so on. The MERs, about 1%, so it's maybe a little bit more than you want to pay, but you are getting some value for that in that they are covered writing the portfolio for you. So again, those covered writing tactics that we had talked about previously are the things that generate the extra income. In this particular case, it's struggled. And so the entry point is not bad at all. And I think, again, they don't always write the entire portfolio. So they allow for some of the portfolio to breathe to the upside. So as an allocation, as something that's very differentiated from a Canadian portfolio as well. So if your portfolio is largely Canadian, there's not a lot of those companies that are overlapping. So it provides a nice bit of diversification. You do get some income. So and it is not one of those areas of the market that is up on a stick or has had massive performance in the last 12 months.
Okay, Mike, thanks for that. We are going to take a quick break. When we return, though, we'll take a look at some of Mike's past picks. That's next. Stay with us. Welcome Welcome back. We're going to take a look now at some of Mike Philbrick's past picks from December 6th of last year. The first one, Harvest Equal Weight Global Utilities Income ETF, recommended at almost $18, now at almost $19, a return of 4% and a total return of 10%. This looks pretty good, Mike.
Well, it's not bad. And it was a recommendation where we were trying to tilt a little bit to, again, that more conservative area. Recall we talked earlier today about utilities being a defensive tilt in portfolios. That's changing a little bit, and we'll talk about that in one of our top picks, because some of the utilities around the world are getting quite growthy with the AI expansion and power expansion. But HUTL, as you said, good dividend-paying stocks, global in its nature, with an active call writing strategy to provide that income. Again, good, still continue to hold it. And again, if you're looking for more growth out of your utility stocks, then it's possible that you go find a global utility ETF that doesn't cover right and make a combination of the two.
Okay, we'll move on to your next pick as well. Fidelity All-in-One Equity ETF, recommended at $14.71, now at $16.24, a return of 10%. Total return, though, of 11%. This, you were talking about this in the last segment, Mike, as a really good example of how to broaden your investments. Do you still like this one?
Absolutely. So when you get into certain economic regimes, and in the past, sort of pre-2022, it was a very low inflationary regime, and that was quite good growth. And that is really good for an economy like the US. But now that we've had a little bit more inflation volatility, that means just that inflation's going up and down a little bit more. It's not so low and steady. And you're seeing that inflation start to bleed into other areas of resources and commodities. What's happening is you're seeing international stocks and emerging market stocks do better than US stocks. And that's Canada. The Canadian market has done better than the American market. So we just want to make sure that we're diversified. And in the Fidelity All-in-One Equity and ETF, it is that diversification across growth across all caps equities in the world. And it's got a small position in Bitcoin to boot, which is just a nice place to have a little bit of that extra boost in your portfolio. So I like it as that one stop for your equity position. Now, keep in mind, the risk caveat here is there are no bonds in it and there is no gold in it. So inflation shocks, you want your gold. Growth shocks, you want your bonds. So you're gonna have to build that out around that portfolio to give it some ballast. But if you're just looking for all equity, that's a great choice.
Okay, your third past pick, this one's CI Galaxy Ethereum ETF. When you recommended it, it was at $20.52. Now it's at $19.55, return of -5, total return of -5. What are you thinking about this one?
Yeah, and that's not the worst of it. I mean, this has been quite a ride. I think this is down more than 50% along the way. So again, with digital assets, they are very, very volatile. And I said this at the time, buy a little, and then when there's a drawdown, rebalance a little. So if you did that, you could probably be up on this. Still very bullish on this. Wall Street has chosen Ethereum as the digital chain that they are going to build stable coins, and they're going to tokenize real world assets on, and they're already doing DeFi on this. So this chain, sort of like your Bitcoin is your analogous gold, this is analogous to kind of the internet of tracking things. So this is smart contracts. That's what Ethereum does. And that's going to be how we actually track assets in the future. And that was what was clarified in the Genius Act and then the following Clarity Act about how stable coins are going to be legislated and how they're going to be tracked, as well as the Genius Act clarifying the legislative side of things for digital assets. Those things are all very, very, very bullish Ethereum. So I would say that yes, still continue to hold this, still continue to build positions. Keep it small, keep it to an amount that you can rebalance that doesn't scare you away. And I think a very small bit of this will help your portfolio immensely. It's like a little bit of salt on dinner, just makes it taste better.
Great analogy. Okay, we're going to be back in just a moment with Mike Philbrick, once again, of Resolve Asset Management, taking more of your questions on ETFs. Stay with us. That's next. Welcome back to Market Call. We're going to go straight to the phones now. Victor calling in from Toronto with a question for Mike Philbrick. Hi, Victor. What's your question?
Hi. My question is about a China growth ETF. Can he give me a recommendation?
Okay, thank you. Mike, China growth ETF. What are your thoughts on that ETF?
First of all, I think the idea of China itself is a good one and a very diversifying one, just because the business cycle is so different from what we have in Canada, and monetary policy is a different moment in time as well. So I like the idea as a complement, and there's a couple of ideas here. So if we think about just focusing in on a single country, then we can look at XCH, which is the iShares China Index ETF. And so the management expense ratio on this is going to be in the 0.85 range or so. And that's because it is a little bit harder to gain access to those securities, and you're trading securities in another jurisdiction. But that's going to give you a pretty good exposure to China and the single country side of things. So I think that's a good place. The iShares has a XEMC as well. Scratch that one. Go with XCH. That's your China-focused single country ETF.
Okay, good to know. We're going to move on to an email question now. This one coming in from Brian. Given all the bluster coming from the U.S. recently, I'm looking for a European-focused defense company ETF. Most ETFs I've come across are heavily weighted to U.S. companies. Any suggestions? This is an interesting question. I feel like a lot of Canadians might be looking for any kind of ETF that doesn't involve U.S. companies. Is that a possibility at all?
Yeah, of course. And we talked about this globally as well, that you're going to want to try and get exposure outside of Canada and the U.S. just from a diversification perspective. And then when you think about defense, it's interesting because it's hard to find something that's defense oriented that is not dominated by America. So in this case, this is a very kind of niche play, but we do have one. This trades in the U.S. and it's the Select Stocks Euro Aerospace and Defense ETF. The ticker is EUAD. So EUAD is that ticker that you're looking for, and that focuses on the aerospace and defense portion of the European market. That's a very, very niche question. It's a very niche ETF, but there you have it. There is an answer. I wasn't sure that there was going to be, but there it is.
Okay, EUAD, Europe Aerospace and Defense. Good to know that there is some kind of answer out there. We're going to move on now. Another phone question. Mark is calling in from Crescent Beach, BC. Hi, Mark. What's your question?
Hi. Yes, I'm wondering about HHIS, whether it's a good place to park some money for income producing in a cash account, so the dividend is tax treated like a capital gain. Okay,
thanks. Mike, what do you think?
Yeah, this is a very interesting product and a very new product. So this is the Harvest Diversified High Income ETF, and it is an ETF of the single stock ETFs that they have. And so it's a number of single stocks, so Apple, Coinbase, Broadcom, Nvidia, Palantir, Netflix, Microsoft. And you can tell by the names, it's also got a little bit of Eli Lilly and Costco, but this is a very, very tech-heavy portfolio. So first of all, a couple of things. We've talked about covered writing. And we've talked about the fact that it's something that changes the way the portfolio works. And because these stocks are all very kind of more on the volatile side, you get lots of income from it because they move around a lot. But to park money is probably, that sounds a little short term to me. So first of all, I'll give you the challenges. First of all, it's a very narrowly focused, very small number of stocks. They're all mega cap stocks. They're largely tech focused. Okay, so you've got that. Then you're covered writing on it, so you're giving up some of the upside to get that income. Generally bullish this area because of the AI rollout, so that's good. It's not a dividend, which is probably going to be good from the perspective of, does the ETF have a dividend? This is where it gets confusing. Sure, it has a distribution, and that distribution is composed of some dividends and mostly capital gains and return of capital. And that comes from the covered writing. So it's a bit of a complex product. It's got sort of a very narrow tech focus. So if you don't mind the narrow tech focus, and that's what you're looking for, and you want this thing covered written, all of that's good. You probably could pair this with a NASDAQ 100 ETF if you wanted to keep some of the upside, or a FANG or a MAGS ETF, both that are very small and focused, but don't covered right and give you the upside. If you're looking to covered right and just get the income, that's great. It's a fairly concentrated portfolio, though. So it's a unique product. Nothing wrong with the product. It's just got some very unique characteristics to it.
Okay, we're going to take a quick break here. We'll be back with Mike Philbrick of Resolve Asset Management, taking your questions on exchange-traded funds. That's coming up right after the break. Welcome back. We're going to go to the phone lines now. Miles is calling in from Newmarket with a question. Hi, Miles.
Hey. Hello?
Hi, Miles.
Yes, good day. I want to get your thoughts on HXQ and your thoughts on ETFs that reinvest their dividends instead of paying them out. Is it a good tax strategy for investing in a non-registered account? Thanks.
Right, so the HXQ is the Global X NASDAQ 100 index, and it's structured as a corporate class ETF. So first of all, the underlying is those NASDAQ 100 companies, those tech-focused companies. That's a great index. It's been doing wonderfully. The next is, I think, as you've noted, it's a corporate class structure. And that's important because it allows for some tax efficiencies in Canadian jurisdictions. So what that does is it allows you to not have to report any of the sort of dividends and things like that come from the portfolio, and the trading internally. So as indexes change and there's changes in the index, this will not kick out any distributions, or at least that's their intention. So for very long-term holds in a portfolio, where you want to build keep your adjusted cost base at $10 and let the thing grow to hundreds of dollars and never sell it, then it does defer taxes. But it's core to keep in mind at the end when you do sell it, that difference between what you bought it at and what you're selling it at, you will pay a capital gains tax on that most likely. So that's not, I don't want to give too much tax advice, but that's the general gist of why the corporate class structures are advantageous for compounding wealth. Now, again, if you sell it, there's tax due. If you sell it at a loss, you also generate a loss. But good underlying index. Global X was a leader in providing this type of structure. And you'd probably just want to keep an eye on that structure itself and make sure that's going to be robust into the future.
Okay, thanks for that. Shiraz now calling in from Scarborough with a question. Hi, Shiraz, what's your question?
Hi, my question is on ZQQI. Sorry, QQQI. I have a small holding in ZQQ, and I wanted to put some more money either in ZQQ, but I thought about putting it into QQQI. It pays a phenomenal dividend, and I don't know if that is risky. What do you think of the strategy?
Okay, thanks for your question. So, Mike, what do you think? QQI, do you care if it pays? I know you were saying it's more of a distribution than a dividend, but is that something that's important to you?
Again, it's for me, no, but it's really about the investor's preferences. If the investor was looking for income, then writing covered calls and having an option writing strategy on an index can do that. It has pluses and minuses. It's not just free income. You're giving up some upside along the way to get that income that you're taking along the way. So QQQI is, again, the NASDAQ 100, so same index, and it's a high income ETF. So they're going to be selling quite aggressively, generally speaking, calls. They're going to be very close to the money. They might even be in the money. in order to generate, the yield that they've been able to get, which is, 14%. But remember, when that happens, you're going to be giving up that upside constantly. So you're not going to get the upside participation. You're going to get it back through income today, which means that you're losing some of that flexibility of when you declare that income. So previous caller was like, I want to invest in the NASDAQ and I don't want to touch it and I don't want any income and I just want it to compound. Well, that's corporate structure. This caller is, I'd like to have some NASDAQ, but I want some income from it and I want that covered writing. And that will provide some downside protection, not a lot, but some. It'll also limit the upside. So it really is a preference. And so for the caller, you've already got some in the QQQ. Splitting it makes sense. And that final split will be up to you and what your income needs are and how much you want to be a growth investor versus harvesting a covered call writing strategy on that underlying index.
Okay. Back to the phones now. Bali calling from Newmarket. Hi there. What's your question?
Hi. Thanks for taking my call. But I must say, right, it's more of a matchmaking job with what individuals like myself will ask, and then how you have to put it right. So I really appreciate the effort. So my question is on this BMO offered ZSP, which is the S&P 500, and what I would want to know is that there's a lot of chatter that not all companies in the S&P index, do that well. So from a growth perspective, is ZSP the right thing to do, or is there another growth ETF, which would help us in accumulating and compounding the growth? Thank you.
Okay, thank you. So yeah, thoughts on ZSP or other options?
Well, yeah. I mean, so first of all, let's go through ZSP. ZSP is the Bank of Montreal's S&P 500 index ETF. This is a very solid choice. It's a 9 basis point fee to own this. So it is a really wonderful time for investors to be able to go and buy large swaths of 500 companies that are leading the world and do that for a 9 basis point fee. So we have to recognize, boy, oh boy, we're privileged as investors. And we talked about a VFV earlier, the Vanguard version of this, which is very similar in its fee, and it's just a preference. Do you like the BMO brand or the Vanguard brand? But from the caller's perspective, the one thing I would point to when we're looking at the S&P 500, and maybe this is the point for diversification as we discussed in the past, is if we look at valuations, the valuations in the US are higher. They're not bubble yet, but they're higher. They're also higher for a reason. The US equity market has produced massive growth in its earnings. And so it's not unjustified that it trades at a higher multiple. But then if we look to Japan and Europe and emerging markets, what we see is much cheaper pricing, much lower price earnings multiples. And we see those expanding. So I wonder if at this moment in time, if I'm thinking about this from the perspective of, I'm not buying the US cheap, I'm buying expensive, and I can kind of buy everything else at its normal PE multiple. And we have this wave of AI that's going to make everything much more profitable. I think it's going to enhance profits over time. That's going to take some time, but it's going to bleed through all companies. So, small caps in the US, they haven't performed well, and they trade at a much more reasonable multiple. And as I said, the other geographical areas. So I would say, yeah, you want some US innovation for sure, but let's go global. Let's make sure we own everything. Global is just the easy way to do it.
Okay.
And that'll be that.
All right, thanks, Mike. That's all the time we have for calls today, but don't go away yet because Mike will be sharing his top picks coming up next. Stay with us. Join us Monday on Market Call. Andrew Moffs will be on the show. He is Senior Vice President and Portfolio Manager at Vision Capital, and he will be taking your questions on real estate stocks. And if you miss Market Call, you can always watch our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel as well. And time now for Mike Philbrick's top picks. We're going to go through these, Mike. The first one, Global X Silver Miners ETF. Seems as though there's a lot of interest all the time in gold, even copper as well. Silver, though, is pretty unique. What do you like about this one?
Yeah, well, first of all, I think this is all based on the fact that we've got this AI build out. And as I've talked about before, if you're bullish AI, then you have to be bullish the manifestation of how AI happens, which is through data centers. That's going to require lots of energy and power. And those are the bullish things for the commodities side of things. And silver runs the gamut between both being somewhat of a precious metal as well as being a consumable industrial metal. And so it has that dual role with solar panels, electronics, data center infrastructure use, as well as being sort of gold's hyped up younger brother, if you will. So supply is tight following many years of underinvestment in the mining sector for silver. And thus, we think that silver's got some possible positive returns ahead of it, and some unique drivers that should drive those returns. Now, keep in mind, it is a little bit more volatile than gold. It's more volatile than stocks even at times. So pace yourself. This is an ETF of silver miners as well. So you're going to get the gearing that comes from being a mining company, meaning that if silver goes up, the mining companies tend to go up even more. And thus, keep that in mind. Also, they've had a big run. So pace yourself. Look for pullbacks to add.
Just quickly before we move on, why is silver more volatile?
Generally because of that industrial application. So gold has buyers from central banks, and it's a little bit more of a currency / precious metal. Silver responds to the business cycle. So when the business cycle is booming, it can do quite well. When we go through a contraction from a growth scare perspective, it can drop a lot. And whereas gold, when you get a bit of a growth shock, sometimes holds up a bit better than silver. So that causes silver to have a lot more volatility.
Okay. All right. I just wanted to know that. We're going to move on now to your next pick, VanEck Uranium Nuclear Energy ETF. What do you like about this one?
Yeah, as we've talked about, in the AI build out, we're going to need more power. Last year, we had the brownfields redevelopment of 3 Mile Island, the nuclear accident. That's where we are. Constellation Energy and Microsoft had to repurpose that to get energy to actually feed these data centers. So nuclear is round-the-clock electricity. Solar isn't, wind isn't, and natural gas, although it's sometimes considered carbon intensive. So if you want clean, carbon-free energy, kind of nuclear is your answer. And so NLR, which is the VanEck Uranium and Nuclear Energy ETF, has got that torque to some of the mining companies, as well as some of the utility operators. And so it gives you a little bit more of a broader play on the power bottleneck that's emerging.
Okay, last pick is Vanguard FTSE Emerging Markets All Cap Index ETF. Tell us about this one. What does this one encompass?
Yeah, and so this is basically Vanguard's low-cost exposure to all the emerging markets in the world. And as we talked about on the show several times, these markets are less expensive. And they're probably where we get a lot of the next decade's growth will be coming from, driven by their better demographics, driven by their rising middle classes, driven by the industrialization, realignment away from China. So most investors currently are probably somewhat underweight emerging markets. And so this is a great opportunity to diversify and to build in a bit of an inflation hedge too, because when we get commodity inflation, the emerging markets tend to do really well. Think of that 2003, 2002 to 2008 period. So these fast growing economies really get traction when we start to get a little bit of commodity price inflation. And so that is just a different and diversifying growth engine for your equity portfolio. And I think, most investors are underweight this opportunity. And if we go back to valuations, they're pretty reasonable.
Correct me if I'm wrong. I feel like we're hearing more about emerging market equities recently. Do you think Canadians are really starting to gain more knowledge and get on board with these?
100%. And it's just like it happened back in, the end of the 2000 internet bubble. The bubble collapsed and, emerging markets and the commodity cycle began. And out of that, a lot of interest in the BRICS. So that was Brazil, Russia, India, China. And so it's always the evolution of investors starting to get interested as things improve. And that interest is definitely happening. So you're starting to see the beginning of that. Better to be early than to be late.
Okay, good to know. Mike, thank you so much for joining us today. Really appreciate your insight on all these different ETFs. Thanks so much.
Thanks for having me. Have a great day and
You
a great
too.
weekend.
Yeah, you too. And thanks for watching Market Call. We will see you next time.